Very good afternoon, good morning. Welcome to HYCM's Look Ahead webinar with myself, Giles Coghlan. Looking forward to taking us through the session. If you just take a look at what we're looking at today, just before we get started, don't forget any entries, exits, currencies that we look at. The whole idea of this webinar is that we're looking at a big picture, and we're looking at this from a perspective of education. So it's not that we're trying to give a signal trading service, even though we talk about different instruments and potential trade ideas. It's from an educational perspective. Those of you who are regular know understand how this webinar works. Right, very good, very warm welcome to you, Gavin. Hello, good to see you. Johan, Sento, good to have people on board. Looking forward to the session. Hope you're all doing well and looking forward to getting us ready. This is a very interesting week, and markets are at a really interesting position at the moment. And really what's going on is a degree of uncertainty. I'm going to show you what that uncertainty is. I'm reading lots of different perspectives and analysts report, some expecting a more hawkish Federal Reserve this Wednesday, and some expecting the Federal Reserve to start indicating slowing rates. I'll show you what's sort of driving both of those groups, and that will help us hopefully respond when we see the meeting. Very, very hard to take a position into the Federal Reserve meeting this Wednesday because of the uncertainties. But what I'm going to do is I'm going to get us ready, look at what the key drivers are, see the key opportunities, so that if we do see a definitive shift by the Fed on Wednesday, we know how to best take opportunity of that. And of course, on Wednesday, I'll do a specific workshop, which is how to trade the Fed meeting. So that'll all be focused on the Fed. That'll be a Wednesday, 12:30 GMT. The clocks have moved now in the UK, so it's 12:30 UK time and 12:30 GMT time as well. So just with you a little bit earlier than normal. So without further ado, let us get stuck into the session. Now, what I want to do is I want us to give us a quick look around what's going on in equity markets to use this as a gauge for what's going on with the Federal Reserve. So let's just take a look at US stocks. Now, what we can see is US stocks have been rising since Friday the 21st of October, really. They were rising before that, but it was Friday the 21st of October when we had Fed speaker daily, just before the Fed's blackout period, sort of gives some hints that the Federal Reserve, might not necessarily hike by 75 basis points at this next rate meeting. They might do, but it could be 50 basis points, and then they could be dropping interest rate hikes as they move forward. So it was one of the first kind of more dovish perspectives that we had from a Fed speaker. And then we had Fed Whisperer Tim Rayo also adding dovish vibes. So that's allowed stocks to start to gain. Now, I've noticed some analysts report that are expecting a hawkish Fed, particularly that on Bloomberg headline, were from interviews done just before 26 of just before around 21st of October. So it's just interesting, that 21st of October daily's comment came a little bit later. So, where does that leave us? Well, it doesn't leave us anywhere obvious, but what we can see is that equity markets have been trading higher in expectations of the Fed maybe giving some kind of indication on Wednesday that they're going to be slowing interest rates. That's what's driving stocks higher at the moment, and that's kind of like what what I was expecting to see coming into Wednesday. We're too close to the event now to start buying stocks in anticipation of that. So it's not a move we want to chase. And we can see, look, S&P 500 Dow, we've got the long-term down trend lines you can see. So at best, all we can say at the moment is this is a bear market rally. Now, going back to look what's expected, we can see on last Friday, we started to see indications that the US employment costs are still high. So what that means is that the Fed is still going to want to try to hike interest rates, to try to bring down employment cost. Remember, one of the big concerns about inflation is when it gets into wages, it means that the problem of inflation is endemic, it's systemic, it's within the financial infrastructure. So seeing higher wage costs, which you can see here, rising again, solid place, third quarter, employment costs are on the up. So the Federal Reserve won't like that. And unemployment is still relatively low. So why is it low? That's the question that analysts are asking. Is it that some people haven't come back to work over COVID? Is it that the economy is still strong, so the Fed could keep hiking aggressively? So the kind of thinking that's going on now is, will the Federal Reserve hike by, will they do too much? And you can see 3/4 of economists now think the Fed is going to over tighten. Now remember, when you hike interest rates, it takes sort of 6 to 12 months for the full impact of those interest rate hikes to come into effect. So for example, say you're looking at your mortgage rates and you see, oh, my mortgage is coming to an end, my current fixed rate might be coming to the end of the middle of next year or the end of next year. So the interest rate hikes aren't going to impact you personally until you come to renew your mortgage at the end of, middle of next year or end of next year. So that's the same for a lot of people. So it's only when a bit of time's gone past does the impact of higher borrowing costs, higher mortgage rates really impact the economy. And so the risk that many economists are seeing is that the Fed are going to go too aggressive. And if you just take a look at what current interest rates are and what's expected, so just look at the interest rates here. You'll see that the Fed's interest rate is at 3.125%, and they're expected to peak just under 5% next year. Okay, 4.84%, 4.9%, just under 50% is expected, and there's a 97% probability of a 75 basis point hike. So that's what's priced in. If we just take a look at the calendar for the Fed on Wednesday, and we need to start with the Fed because the Fed's so influential, we can see that the expectations are very firmly for a 75 basis point rate hike coming in. So that's what's expected, and employment costs are high, but the risk of the Fed over tightening is seen as a real risk. So when we look at stocks, where does that leave us? Well, it leaves us in a situation that if the Fed on Wednesday start to indicate they're concerned about slowing growth, if they hike by 50 basis points, then we'd expect S&P 500 to run up to that next resistance level, that 4,120 region. We expect the NASDAQ to have a run up to 1,200, maybe even a run up to 12,600. We'd expect the Dow to run up to 3,300, probably 3,400. So the expectations at the moment are for a potentially more dovish Fed. That's what's also been causing a bid to come into the bond market. And if you just take a look at 10-year yields, you can see that 10-year yields have been steadily tracking lower. Again, from around, that 21st of October time, you see that was kind of the peak. And then we've seen 10-year yields dropping lower on expectations that the Federal Reserve may be more dovish. So on Wednesday, we're going to see, well, is that a misplaced view? And if it's a misplaced view, if the Federal Reserve once again maintain their hawkish stance, keep hiking, and maybe, I did see a report by Goldman Sachs when they're expecting the Fed to become more aggressive this Wednesday. So there's a whole range of different views out there about this Fed meeting, more so than I can remember for some time. And if the Fed are more aggressive, then we expect stocks to fall sharply lower and start moving back down towards these key support levels. So there's a lot to go on. Now, the other thing to note is China's 50 index. We can't not mention that. Now, this is a really, really dark situation for China. But I think this must be quite close to having all the bad news priced in. This feels very, very overdone to me. Now, this has all been due to President Xi's pivot towards a policy called common prosperity, moving away from more free market principles of the West. We've seen the COVID zero policy being maintained in China, which is the policy of shutting down cities on a relatively small amount of cases. We've also seen the property sector struggling in China, and all of this has led investors to flee China as quick as possible. Now, we had this trend line below 12,000 was an obvious area to get out for those looking to go long. So this is not a place to go long, and if you were long, then this was definitely a place to exit and wait. But China still looks good value, and if you take a very long view, you can see there's nearly a 50% fall in the stock market. So, you know, start looking at these big support levels. So these support levels are worth looking at to see if we start getting some kind of support coming in, and if we see prices moving back above that trend line, this one that we have here, and moving higher again, that could be a reference point. So I think a lot of the bad news is priced in for China. It's hard to see how this can possibly get any worse, and I would expect China to turn around. It is the world's second largest economy, and there is a lot of stimulus packages planned for China, and it is a economy that's set to overtake the US economy by 2030. There are issues. US, China still continue to have trade issues, but over the longer term, China's 50, this is starting to offer quite attractive levels in my view. So just look out for these key support levels, and then look for any retracement back above that level to potentially go higher as opportunities. So looking at these key support levels now for China 50, and of course if the Fed are more dovish on Wednesday, then you'd also expect that to be a catalyst for China's 50. FTSE 100 is looking very attractive as well. Now you can see the FTSE 100 has been falling lower. It's been a whole range of issues impacting the UK. We've had the energy crisis with the Russian-Ukraine issue dragging on the UK economy. The strong dollar has been getting a lot of the financial media press. I've been speaking a lot to financial media in the UK on the strong dollar. The political crisis has been well documented as well. A lot of instability, uncertainty, and remember at the end of September, we did have the FTSE 100 just falling lower on the saga that was going on with the bond market, prompted by the mini budget and quasi-quartering that really sent sort of shockwaves through financial markets. However, you know, the FTSE 100 is like 2 standard deviations below its 10-year moving average, and it's trading at a price to earnings ratio of around 8.5, 8.7. So in other words, it's looking very good value. You can see here you've got a head and shoulders pattern. I do like this pattern, and a definitive way that I would look at trading this is if we had a dovish Fed on Wednesday, then going with the break of the trend line would be an attractive trade. Breaking at 7,100, looking for a move back up to 7,425, 7,450. That's very attractive in my book. Stops can be placed just underneath that 6,680 region, and then you can reconsider getting out if price moves back below that 6,800. So that is an attractive prospect here in the FTSE 100, and is worth you know, marking. Okay, I hope now you can sort of start to see some of the big picture issues that are going on. We had the NASDAQ underperforming the Dow and the S&P 500 because of the tech stocks. Remember, we saw some disappointing headline earnings from Tesla. We had Microsoft disappointing, Amazon, and some of those disappointments have just been weighing on tech stocks. But then Apple earnings with the MacBook Pro doing very well did sort of boost stocks on Friday. So, you know, pretty much flat on the NASDAQ, but you can see we're heading into these the Fed meeting, and traders will start to get cagey from here. They won't want to start initiating new positions. Earnings that we've got a few big names on Tuesday: BP, Pfizer, got PayPal on Thursday after the close. We've got Moderna as well. Interesting to see any vaccine news. A lot of the big names have already come out and released their earnings. So what markets are looking at is any significant revisions lower, any significant evidence of slowing consumers, and that will all be sort of read into the big narrative. But the Federal Reserve meeting will now be taking center stage. Now let's look at the other significant data points that are coming up. And there are a number of them this week that we need to be ready for. Chinese services PMI in contractionary territory, lower than forecast. That is a negative, and that's been continuing to weigh on the Hang Seng overnight. Eurozone inflation remaining stubborn, 10.7% up towards the high of the estimate. So it just shows the Eurozone is still struggling with inflationary pressure, just like every other nation. And the question remains, how sticky is inflation? It is a problem the Fed will have to engage with. Inflation is remaining very high. That's keeping an aggressive central bank policy. So that's nothing there to stop the ECB. ECB met last week, and they kind of, they hiked a slightly more dovish meeting than expected. Do check out my blog. I'll have a full report on that. They were just a little bit more dovish, and that's just sort of more negative for the euro, but the dollar is going to be driving the euro mainly. So that's going to fall into the shadow of the dollar's decision on Wednesday. So there's nothing obviously tradable there with where currencies are at. The Chinese PMI data, that's the private manufacturing data, that will be eyed. If that's another miss, that's more negative sentiment for China stock. The RBA interest rate decision, they took a more dovish meeting at their last interest rate meeting. And what we're looking for here is, what are they looking at in terms of the terminal rate going forward? Now, at the moment, markets are expecting the terminal rate for the RBA to sort of peak at about 4.25%. It's currently now at 3.87%. So the trend is lower. So people are expecting the RBA to be less aggressive. So that's more dovish for the Australian dollar. So if the RBA, and if we just look at the expectations, there's a 78% chance of a 25 basis point hike and 50 basis point hikes coming in at 21.6% chance. So if it is a 25 basis point hike, that will probably be more dovish for the Australian dollar. And we could look at potentially trading something like the Aussie New Zealand dollar, depending on what the unemployment and the employment data that comes up later in the session. So just to be aware of the RBA, if they are more hawkish, that will be the better opportunity. So if they hike by 50 basis points and talk about inflation still being harder and they need to keep hiking interest rates, then looking at buying the Australian dollar, probably against the New Zealand dollar would make sense. Because if you just take a look at the Aussie New Zealand dollar pair, you'll see that the Aussie New Zealand dollar pair has fallen quite a lot now. So it's not necessarily something we want to keep chasing lower. You can see here the Aussie New Zealand dollar pair just falling down to that key support level. And the best opportunity would come from a more hawkish RBA. And we can see we're around that 200 exponential moving average. We can potentially look for a run up to that 150 region. So yes, if we get a more dovish RBA and strong employment data, then we could maybe look at measuring risk underneath that 200 exponential moving average. And we can see the Aussie New Zealand dollar continuing to track lower through the rest of the week. But just look out for that. ISM data, so US data, is going to fall in the shadow of the Fed meeting, but will still be important. So the best opportunity will come from any evidence of a significant slowdown. Okay, so if we see a big slowdown in the ISM data, what we'd be looking for is something like PMI data coming in below 48.9. Bad news will be good news for stocks, because bad news will indicate the Fed will be more likely to slow. So opportunity here, if it comes in below 48.9, then I could potentially look for a quick long in the S&P 500, and you could look for a long in something like a pound US dollar pair, with the pound's relief with the new UK Prime Minister Rishi Sunak. If this is a miss, you'd expect the dollar to weaken as well. So S&P 500 higher, maybe a short run in the pound US dollar. If the RBA are more hawkish, then you could potentially look for an Aussie US dollar long, but it will depend on what happens to the RBA meeting. You've got New Zealand employment data. best opportunity here will come from a miss. The RBNZ is very hawkish central bank at the moment. They really are looking at being hawkish. They're only going to change that mantra when they start to see a slowdown. If they see a slowdown in New Zealand employment, that would be an opportunity. So the best opportunity, if it's high, if it's good reading, that's not a tradable opportunity. The opportunity comes from a miss. And I would be looking at something like the Aussie New Zealand dollar pair. So if the RBA is sort of more neutral to hawkish, and then the New Zealand employment data is very surprises to the low, so we'll be looking at unemployment below 3.1, employment change below 0.2, and the unemployment rate, we want that to that higher above 71.3. If we see that, then we'd look at something like the Aussie New Zealand dollar long would be a nice one to look at. There's also an RBNZ press conference, so watch out for that coming just 15 minutes after the report. So watch out for any contradiction of the data in the report. A couple of Canadian speakers. Bank of Canada was more dovish at their last interest rate meeting, so watch out for any confirmation of that. If they are continuing to be more dovish, then that should continue to weigh on the CAD to the downside. You just look at the CAD as an index. What you can see is the CAD has had a really good run recently. It's stuck up in the top of this range. So, you know, anything more negative, we would expect the Canadian dollar to push lower down out through that range. Now, oil has been a bit supported, so that does support the CAD. You've also got to keep oil prices in mind when you're looking at the CAD. You see that they track each other quite closely. So if we see oil moving lower and a dovish couple of Macklem Bank of Canada speakers, then we'd expect CAD downside. Probably expect something like US dollar CAD upside would be not a bad potential way of trading that, given the fact that you've got the Fed meeting the next day and the dollar may be, if not bid, at least sort of fairly neutral just before the Fed meeting. This is the main day, is going to be the interest rate decision later on in the session. Now, the best opportunity here is going to come from an out-and-out dovish Fed. And that would be good to go long gold, long silver, long stocks. So if you just look, I think gold looks really nice for a dovish Fed. It's been a long time tracking lower. We really are due, you know, a potential recovery here in gold. There needs to be some kind of retracement. And a dovish Fed is most likely to be the catalyst, because you want to see the dollar moving lower, you want to see real yields moving lower, and that can boost gold higher. So we're in this sort of near-term potential support area. If the Fed remain hawkish, there's no reason why gold can't keep tracking lower, you know, back down to this 1550 region. So we have seen significant falls in gold. If you just take, you know, from April, we had 1, 2, 3, 4, 5, 6. We're heading for 7 months of gold selling. Okay, so that's a lot of gold selling that we've seen. The best opportunity for gold will come from a more dovish Fed. So I do like looking to buy gold on a dovish Fed, and you could use this to define your risk. So if the Fed suddenly come out dovish, the stops underneath 1612 would be fine. Similarly with silver, the gold-silver ratio is quite high, so it means that silver is cheaper relative to gold. So again, with silver, you can see it's had in the last 1, 2, 3, 4, 5, 6, 7 months, it has had a lot of falls. Now, interestingly, silver is trying to put in a little bit more of a recovery. Technically, we are just sat on a pretty solid technical level. So once again with silver, a dovish Fed, and it's quite easy to define and limit risk just underneath 1740. So, you know, really worth looking at silver. I prefer silver over gold because of the gold-silver ratio. I'll just show you that here. If you just look at the gold silver ratio, what you'll see is that the gold silver ratio has been tracking quite a lot higher recently. No, that's the wrong one. That's gold silver ratio. Let's see. Let's have a look. Right, this is not the one I'm wanting to use, but this will do. And basically, when this ratio is high, it means silver is cheaper relative to gold. Now, it has tracked a little bit lower since we've been looking at this. This isn't the ratio I'm looking at, but I do still favor. Let's see if I can find it. There we go. That's it. Right. So what you see is, just add silver to this. I'll explain this, how we made a bit of a mess of it. Apologies for that. So when the gold silver ratio is high, it means silver is cheap relative to gold. So a high ratio, and you can see silver can really pick up very quickly. So you can see a high ratio, silver picks up. High ratio, silver picks up. High ratio, silver picks up. The ratio has been quite high, but you can see silver is still due a kind of pickup. So we've had a high ratio, but silver hasn't picked up yet. So it means if there is a reason for the Fed to turn more dovish, then that would be a good reason for silver, the purple line, to pick up. So I do favor silver longs over gold longs, but that would be the best opportunity on a more dovish Fed on Wednesday. I will cover that more closely. Got Bank of England decision meeting on Thursday, and again, looking at what's expected for the BOE, interest rate expectations have fallen recently with Rishi Sunak taking control of the markets. So at 4.95%, 5% peak interest rate was expected for the Bank of England. It's now fallen to 4.67%, 4.8% at the end of the year. So lower interest rate hike expectations. They're expected to hike by 75 basis points on Thursday. So the best opportunity, again, will come if they only hike by, say, 50 basis points or 25 basis points. And then you could potentially look at trading euro pound long. So if this is a surprise to the downside and more more central bankers want to hike interest rates by a lower amount, then look at euro pound upside for Thursday. Now, ISM data will become important on Thursday as well, depending on what the Fed do. Again, below expectations is the best opportunity. So if they're aggressively hiking, but then we see a big miss in services below 52, then you'd expect stocks to rise again. Okay, so look out for that. So if the Fed are more hawkish, but then this then comes in more dovish, that would be a good opportunity buying S&P 500, gold, silver, going long against the dollar. Then 4th of November, RBA statement on the monetary policy, shouldn't be too much of surprises. And then we have non-farm payroll on Friday. Once again, jobs data, very important for the US. We have to interpret this through what's happened by the Fed on Wednesday, but the general expectation is that if the jobs data is bad, that's the best opportunity. So what we'll be looking for is a headline that comes in below, say, 100,000. We'd want the average weekly hours to be falling. We'd want participation rate to be falling. We would want the hourly earnings to be falling as well. Now, in that situation, you'd expect that to be good for the S&P 500, bad for the dollar. So you'd expect something like pound US dollar upside, euro US dollar upside, and you expect upside in gold and silver. So US data crucial. Also look at Canadian data. If you get the Canadian data coming in as a big miss, so if you get the full-time employment coming in, you know, below minus 20,000, and you've got employment below minus 5,000, participation rate falling, unemployment rate, you know, above 5.4%, then you could potentially look at going US dollar CAD long if the non-farm payrolls data is good. So good data will be supportive for the dollar. Bad data for CAD will be the best opportunity, and US dollar CAD upside. Folks, there is so much going on to cover. I'm conscious that I've taken a bit of time trying to set the narrative right, but I think it needs to. There's a lot of different opinions and views out there at the moment. So, yeah. Footsteps says, I'm in an area with poor connection. How can I access a recording after 6 hours? Do check with support. Have a look at the YouTube channel, Footsteps. We've got a HYCM YouTube channel, and it gets uploaded up there. If the majority of the market knew where rates were going, why have they been so wrong over the past 6 months? CN, it's a great question, and it's one people have been continually underestimating the Fed. Over tightening is matched with over inflating. Yeah, exactly. You can see it's a balanced argument, CN, and you're exactly right. Z is to have lower growth with more control. That's exactly what he's wanting. I think that's what that COVID zero is all about, CN. So I'm just getting to the questions now. I think that's what that COVID zero program is all about, control, isn't it? So it's got to be a big element of that. And New Zealand dollar could be forming intermediate term topping formation. Yeah, I wouldn't be surprised. It's been very, you know, we've been seeing some strength come into the Fed. Gavin, ticker is gold silver. Thanks, Gavin. Where was I looking when I needed it? Distinction between actual versus market immediate perception of dovish Fed. Yeah, yes. We'll cover it on Wednesday, what we're looking at from the Fed. So we'll have another good run. CN, great comments. Gavin, thank you for your help. Sorry, you had to painfully watch me faff around with that. And looking forward to being back on Wednesday, going through the workshop, getting ready for the Fed meeting. Main event of the week is the Federal Reserve meeting. And the best opportunity of the week will come likely from the Federal Reserve. So that's what I'm really focusing on. Folks, take care, have a very good afternoon, and look forward to being back on Wednesday. Thanks everyone now. Goodbye.